Hello, good morning. Welcome to FX Street Currency in Play. I'm Matt Brown, and I'm joined down the line by Ed Matz from Matrix Trade. Good morning to you, Ed. Well, let's kick off with the top trends for today. And there seems to be a common theme here being the dollar strength. So looking at the top trends, euro-dollar trading at intraday lows, pro-dollar sentiment prevails. I've got cables slumps to two-week lows near 133.70, albeit trading a little bit higher at the moment as the dollar shoots higher. And dollar yen jumps to 2 months high with King Dollar ruling the roost. This brings us on, Ed, to your first slide, and we're looking at time for safe havens. We have Donald Trump, which I believe is that a Batmobile there, about to run over potentially some of the safe haven assets. So good morning to you, Ed. Talk us through this cartoon you have here.
Well, essentially, it's exactly that. We started with something we've been working on for a long time. A lot of people will know that we're looking and trying to manage the markets into what we believe will be a tumultuous time, stock market crash based on 1929 and 1987. And although we believe we're yet to see the high, what we're seeing is a breakdown in correlations. One of the worries we had, or one of the confusions, if you like, is some of the safe haven currencies. And we've done a lot of analysis looking back through the years as to whether the yen and Swiss franc and even the bond markets in gold are trading like they should be safe havens if we think they're right. We're going into a crash. And what was interesting about the weekend, you saw some risk aversion. Mm-hmm. Just a reaction to the German and the Kiwi and New Zealand elections, but more importantly, what was happening in North Korea. And it confirmed quite categorically that those safe havens, traditional safe havens, are acting as such, which is fine. And yet, 24, 48 hours later, the market goes sideways, which is kind of what we personally, or what we're looking at Matrix Trade, to see the market go sideways. I'm talking stock markets here, and spike higher and then come back down. And what we've seen is obviously with a lot of you saw Yellen, Janet Yellen last night talking a hawkish book. They're going to raise rates or continue to raise rates into December. It's discounted by 50%. And of course, today we've got Donald Trump and his tax proposals, which are all these factors are hawkish at the moment, and that's why the dollar's gone bid, and that's why people are getting arguably overexcited. But for us, it's a question of managing what we think is proving to be a very accurate template. In 1987, yields, dollar went bid into the crash. So I'm actually, although you see stock markets pushing and DAX is ramped on the back of the euro dollar selling off, although it doesn't seem a likely scenario at the moment. From our point of view, it's not being driven by sustainable fundamentals. The technicals are pointing to the same picture. And so what we're trying to do, going back to that great Paul Tudor Jones quote, that you think you're in the business of trading when you're actually in the business of decision making. And the sooner you can make those decisions, the earlier you make those decisions, the better your results will be. Now that sounds great as a cliche, and it's very true, it's proven over time. But when you have a market like we're having at the moment, where the correlations are all over the place, sometimes they're kicking in and not, hence the DAX breakup today on the back of euro-dollar weakness, it's a kind of a hard ball, or several balls at once to manage, which is why this is both an exciting but a very challenging market. And once we can manage the way through what we're seeing, dollar yields going bid, then we suspect, or we very strongly believe, we'll see the scenario we've outlined, which is, if you go to the next slide, Matt, if you could.
Yes, looking at Aussie dollar and a crash map, speaking of crashes. So just talk us through this slide here, Ed.
Yeah, well, you got it in one. This is one of the maps. This is what the Australian dollar did into one of the stock market crash. And you tell me, Matt, because obviously one thing we focus on is trying to identify matching conditions with price action. Mm-hmm. And you tell me, does that look the same as what happened 30 years ago?
Oh yeah, I mean, it's pretty much overlaid straight on. They're one of the same, almost, bar a little bit of diversion. So yes, I mean, it doesn't bode well, let's put it that way.
It doesn't bode well for the Aussie dollar. Now, interesting, the thing that people will not necessarily remember, because they won't have been around in, say, 1987 or indeed 1929, although foreign exchange was fixed by and large in 1929, what they won't realize is that certain things happen when you go into risk aversion modes. And obviously we don't feel like we're in one at the moment because stock market's a bit. But one thing that does happen, you see certain currencies act as safe havens, the yen and the Swiss franc, and they've proved that they are still in that model, which is why now, last 24, 48 hours, they started weakening again on the back of stock market strength. But one of the two currencies that get hit big time, where is the Australian dollar and the New Zealand dollar, which is kind of interesting on the back of the New Zealand election. And the Aussie, you can see, is following a risk aversion path. So dollar strength, going back into the comment about the dollar yields going higher and dollar going higher into a potential market turnaround, you're seeing the Aussies actually mapping it out perfectly. And that what we're seeing now is the beginning of a decline in the Australian dollar that will take us into the opposite for most currency pairs. You'll see the dollar weaken, but the Aussie will continue to weaken as well, which creates some great cross plays in terms of volatility. If you have the Australian weakening and the euro going strong later, then that's Euro Aussie. It's one of our favorite trades for a potential stock market crash, and it kind of strips out the US or the dollar elements to allow us to trade what is potentially a very exciting market.
Understood. So potential trade there, viewers. So moving on, looking at the euro dollar, and just talk us through this particular slide and where potentially this euro can go from here. A little bit of weakness over recent sessions.
Yeah, just a little bit. Finally, Matt, I haven't actually got the euro dollar differential chart up there, but I was talking about the need for it to realign with its differential, and that's exactly what we're seeing now with the breakdown in, a lot of people looked at it in terms of a bullish triangle, but it's quite clearly a head and shoulders. And I've had a bit of fun with this in the last 48 hours because one of the technical formations, the technical formation that everyone knows about is a head and shoulders. So particularly in a market that's very strongly followed like the euro dollar, the world and his wife and his dog knows of this euro dollar head and shoulders, and it's broken down and it has a target of 115.92. But one thing we try to do is actually look at some of these patterns and identify their success rate, because it's important to know the market you're trading, and both DAX and the euro dollar hate head and shoulders. 75% of euro dollar and DAX head and shoulders are bought. So in other words, they trigger the break as euro dollar has done at 118.2040, has a target of 115.92, typically goes 75% of the way to meeting the target, so it looks like a good formation, and then ramps, aborts. What that effectively says, Matt, is in fact that there's a strong high probability trade of fading this euro dollar decline based on the head and shoulders. In other words, you buy 75%, so we're talking below 117, 116.60, 116.90, whatever the price action is indicating at the time, but you buy it against the head and shoulders target, which is the ultimate screwball. As I mentioned before, a guy at chief dealer at Citibank New York said one of his maxims was, what is ever going to screw the market will do it. And that's what we're talking about in the euro dollar. So this meltdown is a correction, but it's going to take out all the balls, etc., and then everyone will be looking at the head and shoulders, getting short for it, and back above it goes, which is interesting actually, because what's the next slide you got there?
Yeah, moving on, we're looking at the euro dollar, the Kiwi dollar, and obviously the Kiwi dollar versus the rate decision tonight. So quickly, just walk us through these three charts.
Well, the first is the euro dollar based on what it does in the German elections. Now, the curious thing about that was everything was pointing to Angela Merkel being re-elected, which you think would be pretty risk on and strong for the euro, because that's an affirmation of stability. And yet, the euro dollar typically does through German elections, it crashes off. So that was kind of like, oh, okay, that's a bit unusual given the predicted election result. And lo and behold, what happens? You've seen a resurgence of the far right in Germany. There's uncertainty. She cannot form necessarily a strong political support in terms of getting the administration and some of the reforms through. And there's uncertainty, so the euro dollar crashes off in line with the average. So, fine, that's great, and it's triggered the head and shoulders, cool, everything seems to, and then look at the chart. what it's saying is in the next 24, 48 hours, it actually timed in at before midnight last night. There's a bottom there and a ramp, which is going to screw the world in its wipe if it actually turns out. But, look, this fractal surprised me, given what it predicted into the election. So why wouldn't it be able to surprise me again or the market again by ramping? And I think that what it says, Matt, is the euro is going to sell off now, and then it will recover through into New York, into Trump, and then start getting volatile. So although that says it goes all the way back up, I think we'll see a ramp in the euro dollar back to the neckline. It's quite a thin volume break on the head and shoulders, relatively speaking. And that typically when you get a low volume break on the head and shoulders, it pulls back because it needs to affirm that it's a head and shoulders. So that's, we should start seeing next 48 hours the euro recover, and then everyone says, oh, that's gone, and then it can crash off again, just in like the election fractal. So it seems to be panning out. And the same thing with the Kiwi, New Zealand election, similar setup, far right resurgence again, denying any strong effective government, although the National Party won again. This the Kiwi election average is based on 3 previous elections, which were all National Party, similar situation, all 3. And you've seen the Kiwi selling off through the election. And interestingly, it's approaching that 71.30 low into the rate decision tonight. So it's getting potentially very, very volatile there. But the Kiwi is a risk aversion vehicle, what for some reason we've called Ravage, risk aversion edge. And what it's saying is, although we should get a ramp again, possibly on the back of no real change on the Royal Bank of New Zealand tonight, coming out and saying, okay, things are looking hawkish, inflation, growth, etc., but politically uncertain, so we're not going to do anything. And you'll see the Kiwi come back up. That's effectively as a selling opportunity for the same crash-related trade. So it's interesting, and as I say, it's exciting and very challenging.
Understood. Well, let's briefly just have a look at the economic calendar. We've got durable goods, pending home sales coming out from the US. Look for crude stock changes as well for oil traders. And really, well, we've got Bullard and Brainard speaking, more Fed speak today. But as you mentioned in the past slides, take a look at the rate decision out from New Zealand at 9 o'clock. And we'll see obviously where that goes. But on that note, Ed, sorry, we're going to have to cut you short. But thank you very much for joining us today on FX Street, Currency in Play. And no doubt we'll catch up with you next week.
Cheers.